you need to only understand one candlestick pattern to make sniper entries. So in this video, you are going to understand how to make this kind of sniper entries using only smaller stop loss. This will be the things that you are going to learn in this video. You are going to learn how to make this kind of sniper entries in this video. The one thing that you might ask is that, is this even difficult to understand? No, it's not, because you don't need any too much trading knowledge to understand this trading strategy. So the one thing that you might ask again is, does this work on all time frames? Yes, even on the 1 minute time frame, this strategy works on all time frames. So another thing is that you might ask, which market can I use this to trade? You can use this starting from the cryptocurrency market, indices, even the stock market. But on stock market, I see that there's a lot of gaps in the market. So that is why I say almost on all 90% of the market, this will work, because here we are focusing on sniper entries with a very tight stop loss. Another question is that, what is the risk to reward on this trading strategy? The risk to reward is over 1.5, and sometimes you can even trade a pair that is going to give you 1-7, because we are making sniper entries. That means we are trading at the lowest point of the market. So let's do a trade checklist here. Here we are going to do a trade checklist. The first thing that you need to check is price is at the potential reversal area, like for instance maybe in the higher time frame zone or on the liquidity sweep. Another thing is that, do we have a lower time frame liquidity sweep? Is price making a confirmation, or a confirmation is available in the market? And also you must have seen that we have a previous swing, so that we can be able to make a take profit level. So from here, this is the only candlestick pattern that you need to memorize and understand. You don't need any candlestick pattern you need to understand from here. So let me explain. Let's say right now we are in a bearish trend like this, and then you see that we have a bearish candlestick, and then you have a rejection here. We need only a rejection candlestick. So on the rejection candlestick, if you put a buy limit order here, buy limit order around this area, that means you are looking for the market to touch this low from this here, from this previous candle, and then your stop loss here, this will be your stop loss area. But if you are only going to take this kind of trades only, then that means you are going to make only sniper entries. And always you will see that the market will give you instant profit. You'll never see too much red unless your stop loss is going to be taken out. And then another thing is that you can still put a buy limit order around here on the close of this candlestick or on the open of this candlestick, because sometimes we can have a gap in between this candlestick and this candlestick. So you can still look to buy here and then look for the price to move to the upside. And then the same scenario works on the bearish setup. You have to see a rejection here. What I mean by rejection is that this candlestick here has to trade above this previous high. The same around this area. This rejection candlestick has to trade below this previous candlestick's low, so that we can confirm that this is a rejection. And then around this area here, you can still look to sell around here on the open or the close of this candlestick here. Then you can look for a retracement and then look for a short even here. And sometimes price can still trade slightly a bit higher than this candlestick's high, but our stop loss will be protected here. This will be our stop loss area. So from here, this is the only thing that you need to focus on, so that at least you can try to understand and see where you will be looking to take those sniper entries only. And then another thing that I want to mention is that in there we have this will be our higher time frame analysis. We have the liquidity sweep analysis, and then we have the supply and demand analysis. This will be your higher time frame analysis. So on the higher time frame, you have to spot this kind of behavior in the market. Or you can spot this kind of behavior in the market. This will be your supply zone. This will be your supply zone. This will be your demand zone. But from here, in the lower time frame, when price reaches this area, this is where you should look for a setup. Even here, even around this area here. From here, because right now you know the candlestick pattern, let's move on to supply and demand analysis. On supply and demand analysis, sometimes you can clearly see that you will have a liquidity sweep in the lower time frame. This is where you should be looking to go long, like this. You'll have this kind of structure because we have this low, and then we have this low here, and then a rejection candlestick. If you spot this kind of behavior, you can look for a long here or a long below this low here. The same thing will apply in this area here, but the structure or the pattern or the candlestick has to be vice versa than this one, because this is just a demonstration to show you how the market is likely to behave. And then on liquidity sweep analysis here, on the higher time frame, you have to find the liquidity sweep, also find the lower time frame market structure. This, after putting this line in your higher time frame, when price breaks above the previous high here, this will be your higher time frame, but this area will be your lower time frame. Lower time frame analysis. Then you have to wait for a break of market structure and then look for that rejection here and then look for a sniper entry. The same thing will apply on this area. When you see something like a support area, wait for this low to be taken out and then look for a break of market structure and then wait for that setup here, for that candlestick formation to make a sniper entry. That's how at least you can try to understand this, but at least it's not even that difficult to understand. But right now, because I have demonstrated everything to you guys, let's move on to a real market chart so that at least you can try to see some few examples to understand this. If right now we make an analysis with this chart here, we can clearly see that, okay, right now price is broken to the downside here, and also price has liquidated this low here, and most of the time you will see that the low that is broken will have a bigger wick like this one here. We have a bigger wick here. Even on this one here, we have a bigger wick. But on this area, this is where we should be looking to go long. So to go long, to make a sniper entry, you have to look at price like this. You will wait for another liquidity sweep, and then from here you can clearly see that we have a liquidity sweep here. We have this low that is being taken out. We have this candlestick, and then we have this rejection. So to go long around this area, you have to wait for price. You can put your buy limit order here or on this open. Then let's say right now you want to only enter around this area. You'll put your buy limit order here, put your stop loss below, and then you can target the previous high that you can clearly see with your own eyes. But in this situation, you can clearly see that the first one that is visible is this one and this one here. And then if we move forward, we can clearly see that the market triggered the entry from this area and price is moving to the upside before we can hit our take profit level. This is the only candlestick that we need to enter on, this one here. You wait for the market to make that pullback so that you can enter the market to the upside. Let's look at another example so that we can clearly understand this. Another example is this one here. This is based on the previous video, because on the previous video I have told you guys that the market likes to move in waves like this, And if there's no overlap in price, that means the market is impulsive. But here we can clearly see that every retracement is coming down to the previous area. You can clearly see that this is very visible. We don't have a gap like this one here where the market makes a top and then we start to consolidate like this. So that means around this area we have a huge gap in the market. Here we have a huge gap. That is why sometimes you see impulses in the market. But in this situation, we don't have that gap. So that means the market is likely to come and trade below this low here. Because after every impulse like this, if we have a move to the downside and then we have a correction like this, so the market is likely to move in the direction of the previous impulse. So in this situation, you can clearly see that the direction of the previous impulse is bearish. So that means right now, after the market has made a liquidity sweep above this high here, you can look to go short based on the rejection candlestick. So in this situation, we are going to trade it like this. We can put a sell limit order on this high, or we can put a sell limit order here, so that when the market retraces back to the previous open or close, you can look to go short. And sometimes the market can give you around 3 to 4 candlesticks before price can shoot to the downside. So in this situation, we put a sell limit order here. This is our first entry, and then we target the previous low. This one here, this is our second entry. We put a stop loss above, and then we look for a potential target to the low. You can also take profit around this area or this areas here. As long if you are targeting any previous low, that one will be your take profit levels. So let's look at how the market behaved. You can clearly see that on this one here, even though it took time, price traded up slightly above this high here and then triggered that entry. If we exchange this, we can clearly see that the market made an entry, but we will put this on the side for demonstration purposes. You can clearly see that this one is 1:60 risk to reward, and also this is a sniper entry, and also the market even dropped lower. That is why I said that price is likely to give you more than this is 1:144, and this kind of thing, it happens a lot in the market. But if you want this kind of entries alone, you can still trade this candlestick only, and they do happen a lot of times. And once prices start to be very aggressive like this, if you still have your, let's say your sell limit order, let's say you are not triggered in the market, then that means you can still wait. And right now, if I clear everything out here and show you from this same chart here, you will clearly see some few examples. Let's say right now, you see that price has liquidated above this previous high here, and also you see this rejection, and then you are looking to go short. You can put your sell limit order. Once this candlestick closes, this is where you should put your sell limit order, and then this candlestick will give you an entry. And then the only thing that you need to understand is find any low, the previous low to target. You can clearly see that we have this one. Then you can put the trade like this, put your stop loss above, and then wait for the market to trigger that entry, and then you will be looking to go short. And by looking at this, you can clearly see that this is a 1:6 risk to reward. And if you are not even satisfied yet, you can clearly see that price broke this high, we broke this high, also we broke this high. But on this one, we didn't have the the rejection candlestick. So in this situation, you can do something like this. Let's cut this off here, and then we will have something like this over here. As I said before, if you want to take only sniper entry, trade below, put the buy limit order below this previous candlestick. If you want to only take the sniper entries, and then you target the previous high, and obviously the market doesn't move in straight line, and then you wait for the market to do whatever it wants to do. Put your buy limit order around this area, put a stop loss below, and then you will wait for the market to move to the upside. And then you can clearly see that the market triggered it, even though I said the market doesn't even move in straight line. And then you wait the market to hit your take profit level. And I know some of you will see that, okay, they sniped the entry here. The market will push to the upside. And then when you start to go lower with this candlestick, so many people will close their trades, and then the market will move and hit their take profit levels. That's how most of you have what you call a fear of missing out, or greed, or a fear of not holding trades while you are already in that risk. Here is another example on the Euro USD 1 hour time frame. We can clearly see that here we have the fair value gap, we have the liquidity that is being taken, and then you are looking at this like, okay, what's going on here? We have an impulse, and then we have a correction here. This is a huge correction. This area alone, this area here, from here like this, we have a full correction. And also we can clearly see that we have an impulse like this, and then that is why you see a correction here. And then right now we can look to go long and target this high, or this high here. So here, by the looks of it, the only low that we have from this trade, from the previous candlestick, is this one here. This is where we are looking to go long. When this candlestick closes on the 1 hour, you'll be looking to go long here, so that the market can push to the upside. Put a buy limit order around here, and then put a stop loss below. And then let's look. Okay, our target is still very far. This is 1:5, and then we are targeting this high first. Let's target this high first. This is a 1:2, almost 9. And then even we can still wait for this high to be broken too, which is 1:40. Let's look at how the market played out from here. You can see on the next candlestick, the market played out perfectly so, and even traded above this previous high, which is 1:14 restored. I hope you understand very clearly on this one. And let's look. Even if right now we are still on the 1 hour time frame, I want to clear some of the things here, so that at least you can try to see some few examples. So let's say right now you can clearly see that we have this low, we have this low, we have this high. So that means right now, look closely, and then we have this high. Let me mark them so that we can clearly see the lows and the internal lows. We have this low, we have this low, and then we have the internal lows, but we don't know where prices tend to go. So from here we can clearly see that we have this internal high here that is being broken. Let's say our analysis is looking something like this, and then we have this rejection candlestick here. So you can look to go short here, or short around this area, and then target either one of this low here, the first one or the second one. So your short position will look something like this, like this. This is already 1:13, and then we have something like this. You put a sell limit order around this area, and then we target this low, which is 1:100. because we are looking for a sniper entry in this kind of situation. So if we look closely, the market triggered only one of the positions, the one that is 1:13, but the one that is 1:100 didn't even trigger. I hope you understand it very clearly. So let's look at another example. If we look at this example over here, let's rewind back a little bit so that at least you can try to see what we mean by this. Clearly from here, price is still bearish to the downside. But obviously, anything that comes down has to move to the upside. There is no chart that is going to move to the downside without even retracing back to the upside. The market has to at least retrace to the upside. So in this situation, from here, we have the same scenario. We have the liquidity sweep to the downside from here, and then we have this candlestick right now. So that means right now we can look for a long position here or here. And sometimes you will clearly see that price will be at a key level around this areas here. So let's say right now we are on a key level like this. Then you'll be looking to go long when price retraces back and then move to the upside. So clearly we can see that price only retested one area before the market can push to the upside. This is how clear this can be. I'm trying my best to at least try to explain it very clearly. And guys, if you have any questions, please communicate with me on Discord. The link will be in the description below. I respond to anyone beside who you are. We are all people by the end of the day. And another thing that I want to point out is that sometimes the market doesn't even give you a valid entry. Like let's say right now, you are looking at price like this. Let's say you say this is your break of market structure, and then you have this high, and then you have this area here, and then you have this confirmation here. This will be a confirmation, and then you have the internal liquidity sweep, and then you are waiting for the market to at least come to this area or break this low here. Yes, you can still use something like this, but if you want to make snapper entries, that means right now your long position, you will be here. Your stop loss is very tight around this area. Then you'll target some sort of high. And even if we do something like this is a 1:15 from the get-go. And then if you look at price, it didn't even retrace back to touch that level that we are expecting the market to reverse from. Most of the time, the market will give you only sniper entries. Let's try to find another example from the higher time frame, maybe to the lower time frame. If right now we look at this price action chart here, we can clearly see that we have the supply zone over here, and then we can still count the waves. If you know how to read Elliott waves properly, you know very well that you will have a 1, a 2, a 3, and then a 4. And in between these areas here, price must not touch each other. So that means some sort of a fair value gap like that. But this level 4 here must not touch the area of level 1. And also another thing is that, let me show you something. If you have a wave like this, we have 1, and then we have 2, and then we have 3, 4, 5 here. So if price, let's say right now we have this, let me label this so that everything can be clear. We have 1, 2, 3, 4, and 5 here. If this 4 here, let me change this at least to be a numeric number so that everything can follow up. You can clearly see that we have 4 here. But if 4 is in this range of number 1, like if 4 is touching the area of number 1, that means right now you are looking at a different thing. That is not an impulse. And then 4 has to be at least above. And 4 must, if you take a Fibonacci retracement from 2 to 3, price must be at 0.82%. And also another thing that I want to point out is that price must not go below the 0.50%. This is an impulse, and after every impulse, price has to correct. And this correction obviously might even go below number 4 here. And obviously, if you see this kind of thing, that means the market is likely to break this high. So for those who are using, let's say, fair value gaps, if I may say, you will see that they will be looking at this to be a gap that needs to be filled. So they will see that, let's say, price is around this area. They will do something like this without even looking at it properly, and then they will see an internal break of market structure, and then they will sell here. But then the market will move lower just to complete this 5 here. I hope you understand. Then that is why most of the time the first break of market structure, if let's say right now you see a fair value gap here, let's say you just see a fair value gap, I don't know where you're going to see it, but then you see this, just look at it in a different perspective. At least you can try to just look at this pattern. At least you can try to understand it very clearly. So let's look at this. We have that gap here. Most of the people will start to move lower here because price is in the lower time frame, and they will move lower maybe based on different things. They will say maybe this is support and resistance level or whatsoever, and you can clearly see that this candlestick is very strong to the upside. This is the candlestick that is going to complete the 5th wave, so that this can be a complete correction to the upside. This will complete the whole correction. So from here, guys, you are going to move on to the lower time frame, because right now you can clearly see that we are on the 5th wave and we are on the supply zone. You can move on to the at least 5 minutes or 15 minutes to look for a setup. And then from here, this is where you should look for that rejection candlestick. This one, it won't even give you an entry. Then you can still wait for another rejection, and in this situation you can see another one here, and then you can trade it. But there is no sniper entry in this situation. If you are focusing only on sniper entries, that means this trade is not for you. You are going to like miss it. And then price is clearly coming back to that area again. If price is coming back to that area, most of the time price is likely to come and trade above it once more. That's one thing at least you can try to understand and see how price behaves in most cases. So I guess this video was very helpful. If you have any information about this, and if you have any question, please consider texting me on Telegram. I will respond. I'm not what I mean, just contact me, guys. I'm always there for you. If you have any question, this channel is for everyone, guys. I'm just doing this for free. I don't know what am I saying. See you on the next one. Also subscribe to the channel. Subscribe.